Okay, good morning, traders, and thank you for joining the week ahead briefing with me, Aaron Hill, one of the market analysts here at FP Markets. So look, last week was an interesting one. UK CPI inflation dipped below the 2%, the BOE's 2% inflation target to 1.7% year over year in September. And this touched a 3-year low and was also, as you can see here, comfortably below the prior data of 2.2%. This was the reading in August. So naturally, this saw the British pound fall sharply and effectively loosen the trapdoor. So the BOE could become more aggressive with policy easing. Now, investors are they're fully pricing in. They're fully pricing in a 25 basis point rate reduction for next month's meeting on the 7th of November, with another potential cut in December on the 19th of December. We are currently pricing in around 44 basis points of easing until the year end. However, while a rate cut is possible in November, of course, this was strengthened by comments from BOE Governor Andrew Bailey in September, with him noting that the central bank could become, and I quote, a bit more activist in easing policy should inflation continue to subside. But we still have to consider the implications of the UK annual budget at the end of the month, and this will likely be the final obstacle for rate setters. Now, on Thursday, we had the ECB out, which we saw the central bank reduce rates by all three key benchmark rates by 25 basis points. This directed the euro lower versus G10 peers. Now, the rate cut marked the first time in over a decade that the ECB opted for a back-to-back rate cut. The move was largely priced in, and this was based on a number of factors, which includes easing inflation, weaker PMI metrics, and of course, dovish commentary from ECB officials. Now, forward guidance, as you would expect from the ECB, was rationed. No surprises there. And the central bank echoed their data-dependent stance and that they're not pre-committing to a particular rate path. Now, because of the trajectory of inflation and faltering economic growth, you only have to look at Germany for that. It should not be surprising that investors are pricing further policy cuts down the road. Now, as you can see here, markets are pricing in around 30 basis points of easing for the next meeting on the 12th of December, demonstrating the potential for a 50 basis point reduction, particularly if we see inflation cool further and growth metrics signal additional softness. That said, a 25 basis point reduction clearly remains a strong possibility as well. We only have to consider that core inflation is north of 2%. In fact, it's far closer to 3% than 2% on a year-over-year basis. And services inflation and wage growth also remain elevated. Now, also on that day, we had US retail sales hit the wires, which came in stronger than expected. So on a month-over-month basis, retail sales jumped 0.4%. This was up from 0.1% prior and surpassed. It was slightly higher than economists' estimates of 0.3%. Now, retail sales, excluding autos, also beat estimates, up 0.5% from 0.1% and the 0.1% prior. Now, the retail control group sales was also up by 0.7%, beating economist estimates of 0.3%, and of course, beating the prior data point of 0.3%. Now, just to add that the retail control group metric is used as part of the calculation for the country's GDP data. Now, in part, the increased consumer spending was underpinned by lower gasoline prices and robust income growth. Now, this resilience in the US economy is unlikely to discourage the Fed. I mean, we only have to look at the US interest rate probabilities, and we can still see that the investors are nearly fully pricing in a 25 basis point rate reduction for the meeting on the 7th of November. With another possible cut on the 18th of December. In total, for the year end, we are pricing in. Markets are currently pricing in 43 basis points of easing. Now, this also follows the central bank announcing a 50 basis point reduction at September's meeting, which took the funds rate down to 4.75% to 5%. Now, moving forward this week, before moving to data, I do want to touch on the number of central bank speakers that are out this week. Now, the one such speaker to watch, of course, is the Bank of England, the BOE Governor, Andrew Bailey, particularly after his remarks about policy easing and, of course, last week's data now being in hand. Now, Bailey will be up on Tuesday, so tomorrow at 1:25 p.m. GMT at an event hosted by Bloomberg. Now, if he notes more easing or faster easing is on the cards, this could send the GBP lower as investors look to possibly price in more cuts. Now, other than this, my focus will be on Wednesday's BOC rate decision. Now, this is getting a lot of airtime in financial news media. Now, this will be released at 1:45 p.m. GMT. So investors, last time I just checked about 10 minutes ago, and investors were pricing in a 99% probability that the Bank of Canada will opt, so a 99% probability that the Bank of Canada will opt for a 50 basis point reduction. And this largely follows September's broadly softer than expected inflation data. Now, a 50 basis point rate cut this week will mark its fourth consecutive reduction and will take the overnight rate, the official overnight rate, down to 3.75%. And this, of course, follows the central bank kicking off its easing cycle in June this year. Now, what's interesting here is should the BOC push with a 50 basis point decrease, this would increase the rate differential between the BOC and the Fed by 125 basis points, which could potentially weigh on the Canadian dollar. Now, if we just switch back to the calendar and head back to the 15th, I think it was, 15th of October. Here we go. So last week, CPI inflation for Canada at the headline level dipped to 1.6%. This was its lowest rate since early 2021 and down from August reading of 2%, and also came in quite a bit lower than the economist estimates of 1.8%, and also lower than the minimum estimate range of 1.7%. Importantly, the CPI, the BOC's preferred measures of inflation, the CPI median and CPI trim, were largely unchanged. If you look at the average, it's still running at an average of 2.3%. Now, we also have jobs data for Canada. That was out on the 11th of October. Just bear with me, guys. I just saw it there and it disappeared. There we go. So employment change for Canada came in much better than expected. And it added more than double the number of jobs in September. Came in, as you can see, 46,700. This was up from 22,100 in August. Also Also something, if you read the details, full-time employment change rose by 112,000. This was its largest gain since mid-2022. Additionally, as you can see here, the unemployment rate dropped to 6.5%. This was down from 6.6% in the prior data and down from the estimate, the median estimate of 6.7%. However, it is worth noting that while the unemployment rate remains a full percentage point above what it was this time last year, though this is largely due to increased immigration rather than job losses. Now, one other thing I want to touch on is GDP growth for Canada has largely stalled. GDP for Canada expanded by 0.2% in July, with August estimated to have stalled. With this, economists forecast Q3 24 growth to come in below the BOC's Q3 24 estimate, which was 2.8%. Now, as noted, a 50 basis point cut is priced in for this week's decision. Now, this is largely due to inflation numbers and the BOC's business outlook survey, and this showed that sentiment does remain subdued. But if you do look at the report, you'll also note that future expectations are a little bit more optimistic. However, on the other side of the fence, a handful of desks call for more caution and a smaller 25 basis point reduction. This is based partly on a loosening labour market and rising GDP growth, albeit less than the central bank forecasted, as noted above. Now, in September, BOC Governor Tiff Macklem also expressed the need for an acceleration in economic growth to, and I quote, keep inflation close to the centre of the 1 to 3% inflation control band. Therefore, this could really push the bank to opt for a bulkier 50 basis point cut, given lower than forecast growth. Now, while the rate decision is expected to take center stage, investors will also be closely monitoring the accompanying rate statement. We also have the central bank's economic forecast. This is the monetary policy report that delivers updated projections. And of course, we have the press conference. So what could this mean for the Canadian dollar this week? So a 50 basis point cut will likely weigh on the Canadian dollar and increase the rate, as we've already said, increase the rate differential between the Fed and the BOC. Though any downside move here could be short-lived, as we are somewhat overstretched short in CFTC data. And let's remember, this will not... So a 50 basis point cut will not create much surprise at least from a rate pricing point of view. So I do believe that if we do see a 50 basis point rate cut, downside may be short-lived. There will be downside, I believe, but it will be short-lived. Now, should the BOC defy market consensus and opt for a 25 basis point reduction, this will create surprise and likely see an unwind in CAD shorts. Now, as you can see from the charts here, this is the monthly chart on the left and the daily chart on the right. The dollar CAD is currently up 2.1% on the month, and demonstrates scope to run higher at least until 39.45 on the monthly chart. And with daily resistance coming in at 37.95, it's all but consumed. It's hanging by a thread here. Punching north of here opens the door to until resistance at 38.66. Therefore, further dollar CAD buying is a possibility on both the monthly and daily charts, and this is really in line with a 50 basis point reduction. Although, as I did say, this could be hampered. This could be short-lived and therefore hampered by that 38.66 resistance on the daily chart. Now, if we move back to the calendar, additional data to watch this week will largely be on Thursday. We have the European, we have the Eurozone, UK and Flash manufacturing services PMIs at 8 a.m., 8:30 a.m. and 1:45 p.m. Respectively. We also have the initial jobless claims. Now, the initial jobless claims for the week ending 19th of October, and this is at 12:30 p.m. GMT. Now, following the unexpected decline of 241,000 last week, from the previous week's rise of 260,000, traders will be watching this print closely, I believe, and will be something that I believe we should also watch as well. Okay, so this wraps up the week ahead, ladies and gentlemen. Thank you very much for listening, and until next week, take care and have a great week ahead.